welcome to this week's MoneyFit Live webinar. My name is Todd Christensen, author of Everyday Money for Everyday People and financial educator, education manager at MoneyFit by DRS. Glad to have you here. This week's topic, Beyond the FICO Pie Chart. Many of you, if you've looked into what a FICO credit score is, you've probably seen the 5-factor pie chart. We're going to go beyond it. There are actually over 3 dozen possible credit scoring factors in a FICO score. There are multiple FICO scores. Even the factors that we're going over today may not apply in every score. Right now, FICO, as of 2020, FICO early this year released FICO 10. Just this past week, they released FICO Resiliency Index, which is a complement to their FICO scores. They're going to look at things a little differently, but generally you're going to get an idea of the FICO score goes far beyond just the simplicity of those 5 factors. Okay, let's get into the basics here. Here are those 5 factors. You'll see if you see the pie chart or a bar chart or anything along those lines. It starts with your payment history, and it conveniently gives you a distribution of it's 35% is your payment history. These are estimates. Please understand that it's going to be different for everybody. Somebody who's brand new to credit has no payment history, so 35% of the score is not going to come from payment history. The same thing with the length of credit. They have no credit. So these are estimates. Things are going to be different for everybody's situation. But payment history, and then you've got the amount of the debt, or what's called utilization, balance to credit limit ratio. Several different ways you can refer to that portion. The yellow is the credit history, or the length of your credit history. Then you have 10% for new credit. What does that mean? Is it just have to do with applying for new credit? No, there's more than that. And then the credit mix, about 10%, which is a little pretty fuzzy even for a lot of financial and credit experts. So let's talk about what the problem with this pie chart is. One, where do you put bankruptcy? It doesn't say anything about public records, collection account. It just says payment history. What about if you're new to credit? How does that affect? Where does that get into that pie chart? 30 days late on a payment versus 120 days late. What about the difference between the payments? We see payment history, but what about is it going to be different if you're only 30 days late versus 60 days or 90, 120, 150, 180 or more? Is there a difference between if you have a credit card from a local bank credit union or a national bank or credit union? There is, but you don't see that here. And then what about what I call corner finance stores? These are the consumer finance companies that tend to lend money to high-risk consumers, high interest rates. There's nothing in here about that, where that goes and how that affects your credit, because it actually does. These are just a few of the problems. There's a lot of things that are wrong with that this pie chart doesn't answer a lot of the questions. It does what it is meant to do. It simplifies it so that we can take a quick grasp, understand it quickly what goes into a credit score, but it leaves out a lot. So you're here because you want to know more about FICO and want to understand a little more of the ins and outs. So let's get into the 3 dozen, just a little over 3 dozen codes. I'm going to keep it in the same sections as the pie chart, so we're going to start with payment history. There you go. You have your accounts are too new to rate. You know, that seems like it could go here because it's payment history, but it also could go under the section that says new credit. That's the thing, is in simplifying, you take different types, different codes, and you have to choose one section that goes in when they can really, they make sense going into 2. Some accounts are just too new to rate. The amount that's past due is Maybe it's you have too much, a lot past due. What do you have in your payment history? The public records or collection, that goes here. Have accounts gone to collection? That shows up. Does that show up in payment history? Does that show up in balance? Does that show up? You know, it really doesn't even make sense here. But these are just some of the things that you've heard about that you assume are part of your credit history. You're just not sure how to fit into that little pie chart. No recent bank or national revolving information. So again, this could go into new credit, but it's actually saying there is no new credit. And it does, the FICO score does tend to weigh more heavily accounts with banks and national lenders than they do with most credit unions. That is not a stick in the eye to credit unions. I love credit unions. I use credit unions as well. But that's just how it is handled by the FICO score. Delinquency level. How delinquent is your payment? If you are making payments on time, of course, it's going to show paid as agreed, okay, on a lot of the credit reports. But if you're 30 days late or more, it'll say 30 or 60, 90, 120. Some of them report up to, I think, 180 days or more late. And the higher the delinquency level, the more serious it is, the more it's going to affect your credit. Number of delinquencies. How many delinquencies do you have? That's another code on your credit report that is going to be taken into account when FICO generates your score. Let's stay with payment history here. There's a few more of them. How about serious delinquencies? Again, this looks like the last one. The last one just said the number of delinquencies. This code actually talks about how serious they are. So this is the one that goes from 30 all the way to 180 days or more. And so it takes into account how many delinquencies, how serious they are. Some of the consumer reporting agencies, so those are as Equifax, Experian, and TransUnion, they don't all have the same codes. Some of them only apply to 1 or to 2. So serious delinquency on a public record and collection, that is going to be very similar to the previous code, but it's only used by one of the collection agencies. Consumer reporting agencies, very different. Perhaps you have too few accounts paid as agreed. If you have, if you only have 2 accounts or 3 accounts and only one of them is being paid as agreed, that's a negative, obviously. The amount of a debt that you have delinquent. Amount seems like it could go under the balance or utilization section, but how much is delinquent? And then what are the payments that are due on your accounts? One of the consumer reporting agencies looks at payments that are due on your accounts. Okay, let's talk about the different codes in utilization. Utilization, we've got amounts that are owed are too high. That's what it is. It doesn't say it too close to your balance or to your limit, credit limit. It's just too high. So it could just be large balances, but it could also be too close to your limit, as you'll see here in a minute. Amounts owed are too high on revolving. So it's not just on debts generally, all your debts or any of your debts. It's specifically on your revolving or credit card debts or retail store cards. So they get specific. It's not just on amounts owed are too high, for example, on a car loan or a home loan, but on that revolving credit card. No recent non-mortgage balance. No recent non-mortgage balance. That means if you don't have anything on there except a mortgage account, they don't really, the score can sometimes penalize you on that. No recent revolving balance. If you don't have any credit cards at all, or at least lately, there can be a negative impact on your score. Here's the balance to limit ratio is too high. If you're maxing out your cards, that's what this code is talking about. And then too many accounts with balances generally. So if you carry small balances on a lot of different accounts, that can hurt probably just as much as carrying one huge balance on one account and having all the others paid off. They look at the whole, try to look at the whole picture. Here's some more when we're talking about credit lines. Utilization on bank and national revolving accounts is too high. Again, it specifically looks at bank accounts, credit cards, the revolving, that's called revolving account. Credit card with a bank or with a national lender is specifically, that's too high. Utilization on all revolving is too high. National bank revolving balances don't have any. Now this one, a lot of people, you will see, hey, you have to carry a balance. This is one of the myths out there. People talk about having a balance, have to carry a balance in order to have good credit. Because, and they might even cite this specific code that, if you're not carrying a balance on your revolving accounts, that could be a negative. You can have excellent, extraordinary, exceptional credit and not carry a single dollar on your balances. You don't have to carry a balance on your credit cards at all. This is just one of 36 codes, and it's pretty minimal. So don't ever fall for that. That's a waste of your time and a waste of paying interest. And then the number of bank or national revolving balances. So if you have quite a few national cards with with balances on them, that's a negative as well. Okay, how about history length? How long have you had your accounts? One code is too new to rate. Again, that's like that first one. You don't know. They can't predict anything. That's what a credit score is trying to do, is predict your future your future behavior based on your past behavior. And if your past behavior is too new to generalize or too new to determine any trends, you can't predict. So if there's not enough history there, you're not going to have a credit, or if the smaller the history, it's going to penalize you because they can't predict and don't know. And instead of assuming you're good risk or no risk, they're going to assume until you prove otherwise, we prove otherwise, that you're a higher risk. Length of accounts, how long they've been established. If you've had accounts for quite a few number of years, that's a positive. Same thing with the revolving. If you had credit cards for a long time, that's a positive. Here's another one, and this is where I refer to again the corner finance company. How long has it been since you've had one of those consumer finance companies lend you money? If it's rather new, they're going to penalize you for that. Why? Because people don't go to those finance companies unless they're in trouble. And if you're in trouble, you become a higher risk for borrowing, meaning you're more likely to miss payments in the future. So that's where it comes up with the finance company. Okay, how about new credit? Again, too new to rate. Don't know. Recent installment. Do you have a number of recent installment loans that you've taken out? Again, if you're taking out a lot of new credit recently, a lot of new loans, it's indicating there could be trouble in your finances. Maybe no recent installment or no recent revolving, no recent credit cards. If you haven't used credit for a long time, then you become a little harder to predict how you're going to use credit in the future, and so it might penalize you a bit. These codes are not made up out of and pulled out of a magic hat. They all have to do with the ability of the credit score to predict your future behavior. Each one of these becomes there's a reason for it to be there, because it is a reliable predictor of future behavior. Your delinquency is too recent or unknown. If you've just missed a payment, that one's pretty clear. If you just missed one payment, you're more likely to miss a second one than somebody who hasn't missed a payment in 20, 30 years. Public records or collections are too recent. The newer the bankruptcy, the newer the collection account, the more risk we are of defaulting or missing payments in the future. And then time since a new account is too short. If you just open up a new account, again, hard to predict what kind of behavior, a pattern of behavior there is with just that brand new account. So that's new credit. And it continues with a few more. Too many recently opened accounts. Same thing. Applying for a lot of new credit recently is a high risk factor. Too many inquiries, even just applying, even if you get denied, The denial itself doesn't hurt your credit. It's the inquiry that is generated. It's called a hard inquiry or an active inquiry, and it's generated and put on your credit report, and that's going to have a small impact, negative, typically 1 to 2 percentage points if you have fair or decent credit, more if you have poor credit, probably, and virtually nothing if you have really good credit. And then how long has it been since the last inquiry? Has it just recent? Has it been recent? Then it can hurt rather than if it's 10 months old, 11 months old. Actually, after 12 months, that inquiry is removed from your credit report. Excuse me, I shouldn't say that. It stays on your credit report for 2 years, but after 12 months, it's no longer a factor in your credit score. All right, and the last section of the pie chart is the credit mix. If there are too many finance companies, those consumer finance companies on your credit, that's a high risk. You're a high risk. If you've got very few or way too many, perhaps, established accounts, the number of accounts matters. Too few bank or national revolving accounts. If you don't have enough credit cards with a national lender or with a bank, if you only have 1 or 2 credit union accounts, your score is going to be limited versus the other. It doesn't mean you can't have excellent credit. You can still have excellent, exceptional credit, even if you only have 2 credit union checking account or credit cards. So don't think, oh, I only have these 2. I have to go build my credit and get another one. No, that's not what I'm saying. There are too many bank or national revolving accounts. Okay, that you can have too many accounts open, and then too few with a recent payment. This is part of that whole mix. They like to see some activity so that they can generate predictions in the future. If you haven't, because recent behavior is a better predictor than distant past behavior. So if the only activity you have on your accounts is from 5 years ago, it's not a great predictor of how you're going to behave with credit in the next 6 months or 12 months. Versus if you have recent payments in the last 2 or 3 or 4 or 5 months, then it's a better predictor of future behavior. So that's why, because a lot of people don't like that. They say, well, they're forcing me. They're trying to feel like I'm being forced to make purchases on credit cards just to have good credit. It has an element of truth, but it's because in order to predict future behavior, you need recent activity on your credit report. Okay, if you have learned something new, please do like this video on YouTube and consider subscribing so you can join us again or hear about upcoming videos that we do. We do these every Thursday live with live chat. You can also find these on our website, moneyfit.org/live. There will be a link there. We appreciate you subscribing. It helps us get the word out to more and more people because this information is not available in any easily accessible place. If you have any questions, do give us a call, 208-286-3283. You can email me at todd@moneyfit.org. And again, find us at moneyfit.org/live. Thank you, and I wish you all the best. Hope you have a great day.